You may have been asked by a stockbroker, a product promoter, or a fund manager to get your sophisticated investor certificate, or you may simply be just curious as to what it is. In this video, I'm going to go through what it is. I'm also going to talk about how it makes you different from a retail investor, who can get it, how do you get it, why would you want to get it, and most importantly, what are the risks? This way, you will understand the legislation, you will know the correct questions to ask the right people, the lingo will be understood so it doesn't just go in one ear and come out the other, and finally, does it get you the better investment returns? And the first thing is, don't sue me. This is just general advice. You need to go to my disclaimer, which is linked in the description section of this video. And by going past this point in the video, you agree to be bound by the terms and conditions of the disclaimer. To understand the differentiation between retail investors and wholesale investors, you effectively need to go back to the Corporations Act. Now, the Corporations Act is some legislation that covers the whole of Australia that ASIC regulates. And basically, it states that anytime you pull money, so you collect money from multiple people to invest, it is deemed to become a financial product. There are some exclusions to the rule, such as direct property is not a financial product, and direct lending between two peers is not a financial product. But everything else, such as shares or managed funds, will be seen under the Corporations Act as a financial product. From what I've just discussed, you'll note that I talk about retail investors. Now, almost everyone, unless they qualify as a sophisticated investor, is considered a retail investor. Now, my simplistic definition of a retail investor is basically an average, everyday mum and dad Australian who's looking to invest their money and needs to be protected by ASIC. As I mentioned before, the other type is sophisticated investors. Now, these are considered wholesale investors, sophisticated investors, professional investors, or they fall under some exemption. For the first part of the video, I'm going to talk about the exemptions because that's the quick bit. And then for the rest of the video, I'll talk about the professional, sophisticated, and wholesale investors under one group definition, which is wholesale. For the sake of simplicity, they're all slightly different, but I'll just group them as wholesale investors. The first exemption is for small scale offerings, basically known in the game as the 2, 12, and 20 rule. If you're raising less than $2 million in a 12-month period from less than 20 people, the Corporation Act requirements of retail and wholesale investors does not apply. Firstly, if you're in the business of doing this, as in you're doing it more than once, technically you still need to have an AFSL. And also, if you're going out and promoting it to people you don't know, technically you shouldn't be doing this. You should only be introducing the investment to people you know or have already had dealings with. The next exemption is if you invest over $500,000 in one investment, technically you don't need to qualify as a wholesale investor. Now, I find this rule a little bit irresponsible because if you don't meet the criteria of a wholesale investor, you probably shouldn't be putting $500,000 into one investment. Finally, this is not actually an exemption, but technically if the AFSL licensee believes that you have the qualifications to understand the investment and understand the risks and all these other criteria, they can allow you to access that scheme even though you don't qualify as a wholesale investor. How do you become a wholesale investor? Well, there are criteria that you need to meet that your accountant will confirm. The accountant will provide you a certificate which you'll provide to the product promoter, and then they'll allow you to invest. Effectively, this puts all the risk of you qualifying under those criteria back with your accountant, and this is why they will want to make sure that you meet that criteria. This brings me on to my next question, which is what is the criteria and how do you qualify? Well, don't hate me, because the criteria often relate to net worth and wealth, not so much as financial literacy. And from my own anecdotal experience on the ground, some people with a lot of wealth probably shouldn't be considered a wholesale investor, and some people with a lot of financial literacy don't necessarily yet have a lot of wealth. I've got the criteria here in front of me, which I'm going to read out now. Basically, you need gross income over $250,000 on the previous 2 financial years. Or the other option is you need to have net assets over $2.5 million. Or the other option is you need to have gross assets, not net, so gross assets that you control over $10 million. Or you need to be an AFSL licensee like me. The other option is you could have a large business that employs over 20 people. The quirk in this is if you're in manufacturing, you need to employ over 100 people because clearly you're less financially literate than other industries that only employ 20 people. And the final criteria, which is the most important criteria, is subscribing to this channel, because every wholesale investor should be subscribing to this channel. So go down there, and you know what to do. Just click that subscribe button. For the sake of this video, most people watching will qualify under the $2.5 million net asset test or the $250,000 gross income. So what I'm going to do is dig into the interpretation of these things in a little bit more detail. What does gross income include? Well, effectively, gross income includes your wages as well as bonuses, rents from rental properties, interest that you receive, basically every form of income, excluding all deductions, so the full form of income coming to you in a tax year. And if you are investing with a partner, such as a spouse, their gross income can be consolidated into your gross income and you can invest as a partnership. And for the business owners out there, if your business turns over more than $250,000 in revenue, it's not profit, revenue, then you may still qualify under the $250,000 gross income test. Also, it's worth noting if you don't entirely own the business but have a controlling or beneficial interest in the business, it is a little bit of a grey area that hasn't been clarified by ASIC, but you should probably speak to your accountant to see if this interest in the business can allow the income of this business to qualify under the gross income test. All these interpretations around the gross income test could be used as counting principles under the net assets test as well. It is also worth noting under the net assets test that your superannuation and your primary place of residence as of the date of this video can be counted towards your net assets, but there is a lot of pressure to have this changed. The next question that commonly gets asked is, once you personally qualify under the criteria, can you invest through another entity? Now, you can invest through trusts, you can invest through companies, provided you have control of those entities. So that means if you have a family trust and you as a trustee or you as a director of a trustee company qualify under the criteria, then yes, that family trust can invest through your S708 certificate. The other grey area worth noting is self-managed super funds. Now, up until recently, it was believed that super funds or self-managed super funds had to qualify in their own right in order to be considered a wholesale investor. Now, ASIC has come out and clarified that if members of the super fund do qualify as a wholesale investor, then the super fund itself can invest in wholesale products. But ultimately, at the end of the day, this is only general advice and you should speak to your accountant or financial advisor as to if your self-managed super fund does qualify as a wholesale investor. Now we're moving on to the fun stuff, which is why would I want to be a wholesale investor? So to do that, the first thing we want to look at is what types of investments can retail investors invest in, and then contrast that to what types of investments wholesale investors can invest in. Retail investors can invest in IPOs and publicly traded companies on the ASX. So this covers things such as REITs, LICs, ETFs, and direct companies. They can also invest in MISs or managed investment schemes that have been registered with ASIC with a PDS. They can invest in direct property, they can do direct lending, and they can invest in investments that fall under one of the exemptions which I've mentioned. This list seems fairly comprehensive, but there are some areas that retail investors do miss out on, such as pre-IPO raisings, seed rounds, capital raisings for wholesale investors only, or S708 deal sweeteners such as unlisted options or convertible notes. There are hedge funds that you're not allowed to invest in unless you're a wholesale investor. And ultimately, the final thing is MISs or managed investment schemes or syndicates or unit trusts, whatever you want to call them, that effectively are only limited to wholesale investors only. To give you an idea as to why those things that I just mentioned don't go to retail investors, I'm going to tell you from a perspective of an AFSL licensee why, for those types of investments, we seek wholesale investors only. The first thing is costs, and to make a retail PDS, there needs to be a range of extra things that you don't need for a wholesale investor. These include correct structure, this includes legals, it includes audit, it includes insurance, it includes compliance, and a whole raft of other additional factors. In most retail offerings, these can cost upwards of over $100,000, which on small deals is not viable. The next point is disclosure and complexity. In this space, deals come and go very quickly and they can be quite complex. In order to get the disclosure up to a benchmark of a retail investor, it does take time and the deal may have already gone. And this is why wholesale investors with less disclosure get to see opportunities first. The third point is kind of a self-fulfilling prophecy, is the fact that the qualification criteria of a wholesale investor is a high net worth, meaning that the capital pools for wholesale investors is quite deep. So rather than the extra complexity of a retail offering, you can often go to the wholesale investor network and get the offering done in large chunks quite quickly. And the final point is the burden of risk for a product manufacturer. Effectively, it is a commonly accepted principle that the wholesale investor market is buyer beware. So what are the perks of being a wholesale investor? Well, first things first is you do see a lot more investment deal flow. Now, I am going to repeat that. You see more investments. It doesn't make them better investments. Think of it this way. Think of it as a bell curve. Effectively, as a retail investor, the bell curve is a lot tighter because there's a lot more governance and regulation. But as you transition to the wholesale investor market, the bell curve starts to spread, meaning that more deals are effectively going to blow up and you're going to lose all your capital, and potentially more deals are going to return slightly higher than what a retail investor would get. You will also get the opportunity to invest with a smaller group of people in small scale offerings. Now, this means that effectively you can talk directly to the manager, you'll sit a lot closer to the asset, and you may make some decisions on what happens with the asset. Ultimately, you might have more impact on your own investment returns. The third thing worth mentioning on wholesale offerings is that less of your invested capital goes to expenses such as governance, compliance, and insurance, meaning that if you have like-for-like investments on a retail offering and you've got lower costs, ultimately as a wholesale investor, you're going to make a bit more money. What I've just talked about is the perks, but what is the disadvantages of being a wholesale investor? Firstly, and most importantly, I'm going to hammer home this point and repeat myself, you will see more investment deal flow as a wholesale investor, but this doesn't necessarily make it better investments. Effectively, it is a bell curve. As a retail investor, the bell curve is quite a bit tighter because of more governance, and as a wholesale investor, it is more likely you're going to blow up your money on one end of the spectrum, and you might potentially make high returns on the other end of the spectrum. The next thing worth mentioning is fees, and this is my own anecdotal experience. With capital raisings through brokers for wholesale offerings, I often find that the capital raising expenses are ultimately higher than retail offerings, and your invested funds is funding some of the capital raising expenses. Some funds do offer discounts for wholesale investors versus retail investors, and syndicates for wholesale investors, the fees overall are often higher than retail offerings because the funds are smaller and they don't necessarily have the scale. The next thing worth mentioning is the quick turnaround time for wholesale investments. As I mentioned before, the capital raisings are often smaller and the turnaround time expectation is often quicker, meaning that you may not have as much time to conduct thorough due diligence. The next thing worth mentioning is quite important, and that is that wholesale schemes don't have to have any form of PI insurance, meaning that no insurer has done any due diligence into the capability of the manager. Also, wrongdoing is traditionally left up to the investors to enforce through litigation, whereas with retail offerings, ASIC and the ASX often step in to act more as a financial police force. Now, it's not always, ASIC does sometimes step into wholesale schemes, but traditionally they are there more inclined to look after retail investors. I have alluded to this before, but the tests that ASIC deem under the Corporations Act to qualify you as a wholesale investor doesn't necessarily give you the financial literacy in order to be able to do the correct due diligence into a wholesale investment scheme. And the final risk to wholesale investors is not subscribing to this channel, because I will be going through in greater detail the due diligence wins and mistakes I make on investments so that you don't have to make those mistakes. So go down there, click the subscribe button. Yep, you won't, you're scared. So now you know what a wholesale investor is, how you become a wholesale investor, what are the advantages of being a wholesale investor, and what are the risks of being a wholesale investor. Now, this doesn't necessarily mean you go out and make a hell of a lot of wholesale investments, but get your financial literacy up so that you can conduct thorough due diligence on a range of different schemes. And until you find a great scheme or the next video, best of luck and goodbye.